A few words of introduction. I'm Thayer Patterson. I work with Miguel Centeno to organize the PIIRS research community on global systemic risk, and we're near the end of our second year, and we've been looking at subjects of systemic risk across multiple domains. So whether it's the financial system, electricity system, food, water, agriculture, the internet, and we're looking at ways that we can learn, lessons we can learn from one system that we can apply to another system. And today we're very fortunate to have Duncan Watts here. And I'd like Matt Salganik, who is Duncan's former graduate student, to introduce Duncan. And just a quick word on Matt. He is an expert on social networks, teaches an undergraduate class on social networks, and teaches statistics to graduate students. And so, not surprisingly, he studies the interaction and the interface of statistics and social networks. Matt.
Thank you. It's my great pleasure to introduce Duncan. For those of you who have done a PhD, you'll know that it's a special privilege to be able to introduce your advisor. So I first met Duncan when I was a first-year graduate student, and I was actually at Cornell at the time, and I found working with Duncan to be so exciting and so interesting that I ended up transferring and going to Columbia so that I could do my dissertation research with him. One of the things that I find really exciting about his work is that he's always doing new things and pushing interesting boundaries. And so he's been really a part of, I think, starting two of the most exciting things happening in social sciences now. So some of the work that he did in the late 90s with Steve Strogatz about small world networks really invigorated interest in networks in the social sciences and the sciences more generally. And then, as if that was not enough, then he much earlier than many other people realized the potential for the digital revolution to change the way that we do social science. So long before the word big data was in the New York Times, Duncan was doing that kind of research and really a pioneer in this area. And but what he's going to talk about today is a little bit different than both of those things. But what this talk, I'm sure, will illustrate is one of the things that is a common theme in all of his work, which is taking the problem that you're working on very seriously. So I've talked to Duncan about this paper several times over several years. He's been working on it a long time. And one of the things that was always impressive about those conversations was the struggle that he was going through to try to understand the problem. And so now we're going to get to reap the benefits of all of that struggling. So Duncan?
Thank you, Matt. Although what Matt stopped short of saying is that I've sort of actually given up on the problem. It's too hard. At least it's too hard for me. So I'll tell you why it's hard for me, and then I'll tell you what we tried to do about it. We being Charlie Brummett, who was an intern at Microsoft Research a couple of summers ago. He's now a postdoc at Columbia University, and Rajiv Sethi, who's an economist at Columbia and Barnard. So why is this problem difficult, or what is the problem actually to begin with? And so the problem has to do with systemic risk in financial systems in particular. And what do we mean by systemic risk? As with many of these words that we sort of bandy around, it's not entirely clear what the definition is, or that people who use it are all using it in the same way. The way that I think about it, and certainly the way that it's written about it in at least some papers, is that we want to try to capture this notion that a system can receive some sort of external shock, and that some other property of the system itself then amplifies this shock endogenously to produce a much, much larger effect. And so, one of the things that I think people don't appreciate about the last financial crisis was that it really wasn't the subprime mortgage market that was important, right? It was, people sort of think, oh, the financial crisis was caused by bad lending practices in the subprime mortgage market, and there's a lot of attention focused on those practices. what was, and that's true, there was a lot of bad stuff going on, and it did result in a loss of, sort of roughly $100 billion in that particular market. But $100 billion is actually not a huge amount of money on the scale of the global financial system. And if you sort of remember back to the early days of the financial crisis, before people realized how bad it was, there were a lot of statements coming out of the Fed and the Treasury saying, listen, this isn't great, but this is contained to the subprime mortgage market. It's not a big deal, right? So what nobody anticipated is that even once you knew about that shock, right, the real damage was that that shock somehow got amplified by other parts of the system that we don't really understand. That is the systemic risk part of the story, as far as the part of the story that I want to focus on and call systemic risk. You could say there are, the origins of the subprime mortgage meltdown were also systemic in a different sense, but that's not what I want to focus on today. Okay, so that's the sort of high-level idea that I want to try to capture. But I think, if we want to make this idea useful, if we want to take systemic risk and use it in an engineering sense or in a design sense or in a policy sense, we'd like to have this definition sort of sharpened up in a variety of different ways. And one property that we would like it to have is that we want it to be sort of quantifiable before the bad things happen. We want to be able to look at a system and say, this system has, X degree of systemic risk in it, and this system is more risky systemically than this other system. I make some policy change, and I've increased or decreased the amount of systemic risk in the system. We would like to be able to make statements of that flavor. We would also like to be able to use it in an ex post sense, to be able to look back at the last financial crisis and say, so much of this was due to exogenous things outside of this system, and so much of it was systemic in the sense that it was being generated by the system itself. A third property that we would like it to have is we don't just want to be able to sort of look at the whole system and say how much risk does it embody. We'd like to be able to locate the origin of that risk inside particular actors or practices. Otherwise, it's not clear what we can do about it. But a regulator wants to be able to say, this particular bank is behaving in a certain way, and that's generating a certain amount of systemic risk. And now I have a cudgel that I can take and force that bank to change its practices. Otherwise, it's very hard to justify things like capital requirements that are costly for individual actors who therefore naturally resist any sort of regulatory oversight. And if you don't have something on the other side of the scales to say what you're doing is costing the system somehow, it's hard to justify that sort of regulation. And then the final property that we would like it to have is that we can talk about it in the context of particular crises without always sort of fighting the last battle, so to speak. There's a very nice report written by the National Academy of Sciences. I think Simon was involved in the writing of this report. It was written in 2006. It was really focused on hedge funds, right? People were really worried about hedge funds as generators of systemic risk because guess what? It was hedge funds who were, sort of thought to be responsible for, well, LTCM was a hedge fund. People were really worried about these highly leveraged hedge funds sort of wreaking havoc in the financial system. Nobody was worried about banks in 2006. So this is all the bad stuff that was about to cause the next crisis is already happening right under our noses, and we're not even paying attention to it. So we want to be able to talk about particular crises, otherwise how can we do anything? But we also don't want to be sort of overfitting to the last thing that happened. And I would say that we actually are nowhere near having any such definition, any definition that satisfies all or even some of these properties. So this is the problem that I think we should be trying to solve. But it's very difficult to solve, and there are very good reasons why it's difficult, and there's very good reasons why it's been hard to make a lot of progress. I was just saying to a group of people earlier this afternoon, as a modeler, the situation that you want to be in is one where one thing really, really matters, one mechanism really matters, and everything else is sort of order epsilon, right? And then you can focus on as I tune this knob, as I change this effect, how do the properties of the system change? The problem with financial systems is that there are actually a lot of different mechanisms that are even different types of mechanisms, there's different categories of mechanisms. All of them are responsible for systemic risk in very important ways. You can't really neglect any of them without leaving out an important piece of the puzzle, and of course they interact with each other as well, so that's a bad situation to be in. And when you have a lot of these different channels for risk to propagate and you have interactions between these channels, it makes policy decisions very, very difficult. So let me just say it in a little bit more detail. That we can classify these mechanisms into 4 broad categories. The first one we might call correlated exposure. So this is a situation where you have a lot of actors in the system who are holding the same types of assets. And so if there is a shock to this particular asset class, then lots of different banks can get shocked at the same time. So this is a one type of systemic risk. It's almost a trivial kind of systemic risk, right? That there's not really, the endogeneity here is that some process happened beforehand that got everybody buying the same type of assets or diversifying their assets in the same way, which is sort of what happened with CDOs. And then when one gets shocked, lots of them get shocked. So a very different kind of mechanism is what we might call knock-on contagion. So there's been a lot of papers written in the networks literature about this sort of contagion, where you now imagine you've got a network of entities like banks. One of them gets shocked and possibly becomes insolvent, and then there are these ties of interdependency. There are these interdependencies that come from loans, for example, where banks hold each other's debt, and then that with an initial default can then propagate through a network in this sort of standard way that dominoes can topple each other. And so this is a sort of very intuitive notion of contagion, but notice it's very, very different from the previous type of contagion, which has to do with the types of assets that are being held by these different entities. So here there's no requirement that banks be holding the same types of assets. A third type of contagion, which is again very different, is again related to people, different actors holding similar assets, except now there's not an external shock that's happening. There is an endogenous effect that is being driven by the market, right? That if I am distressed, I have to suddenly sell my assets at a bad time. That can depress the price of those assets on the market. If everybody else is operating according to market accounting, suddenly all of their assets become worthless as well, possibly forcing them into distress. So entities that had done nothing wrong and were not in trouble suddenly become in trouble. This is different from knock-on contagion because it's not like any of these banks necessarily have any direct relationship with each other. They just have an indirect relationship that's mitigated through the market. And then a variant of this, which is an important variant, is when banks have multiple assets, and sometimes one of those assets is healthy and the other one is unhealthy. You may have to sell off the healthy asset in order to cover your losses in the unhealthy asset, driving down the price of that asset. And so now you can see not only contagion between entities, but contagion between asset classes, and there's some famous historical examples of this happening. And finally, a fourth, and again, different type of contagion is what we refer to very loosely as information contagion. And this is really a type of contagion that happens in the minds of people, right? That something is happening in the world, information arrives that suggests that an asset class that was previously thought to be safe is no longer safe, and so people start to worry. And when people get worried, they start doing things, and it's the things that they do that then cause the problems, right? So bank runs is an example of this. Gary Gorton spoke in this seminar series, I think, a couple of years ago, and he has this this notion of information sensitivity, that an asset class is information insensitive when people don't even sort of think about any problems that might be associated with it. It just trades at par value, and then suddenly people start to worry. And it's not that they even know that there's anything necessarily wrong, they just know that something might be wrong, and maybe you know something about this that I don't know, and so now we have this asymmetric information problem, and now I don't want to trade with you. And so we saw this happen, a huge amount of this happen in the last financial crisis, where whole markets just dried up overnight because people were worried that they were going to get taken advantage of. So these are 4 very different types of contagion. They operate on very different principles. All of them happened in the last financial crisis. They probably all interacted with each other in some sort of complicated way. When we look at models of systemic risk in financial systems, almost all of them pick out just one of these mechanisms, right? And again, because that's sort of the only thing you can do when you're modeling. You want to just focus on one thing at a time. And so necessarily they're ignoring, 3/4 of the problem. So then it gets worse. That even if you sort of agree on the mechanisms you want to include in your model, it's not clear what the actors are, what the units of analysis are. So some people want to write down models where banks are the unit of analysis, but you might also want to write a model that has sectors. That's what we're going to do today. You may sort of parse things out in terms of institutions. You might even sort of think about the relevant units of analysis as being functions, that some models even look inside a single institution, a single bank, and say, no, a bank is actually a complex ecosystem of trading desks and sales desks and all kinds of other things, and there's this internal dynamics that you have to understand, and that's actually possibly even more important than the relationships between banks themselves. So, so this makes things very complicated, and I think it's also fair to say that the literatures that have tried to grapple with systemic risk are also somewhat distinct. That there is a networks literature that has been sort of largely populated by physicists or ex-physicists, and then there's a finance literature that is sort of much more game theoretic and not so interested in networks, and also possibly more historical. And so these literatures haven't really tried very hard to interact with each other. So that's sort of all the bad news. And again, I'm sort of a little bit, I'm not terribly optimistic that these problems can be sort of solved with some kind of brilliant insight. But that said, I will then spend the rest of the talk talking about a sort of very tentative modeling attempt that the 3 of us made a couple of summers ago that sort of takes one step in the direction of a modeling strategy, and then at the end I can sort of describe some next steps that actually we haven't taken yet. Okay, so the core of this model starts with the notion of the balance sheet. So this is a very fundamental idea in finance. I think it's pretty critical to get this right, because this is actually how we evaluate banks in the real world and how we evaluate the financial health of a bank. And so the idea is that a balance sheet is divided into 2 sides: assets on the left-hand side and liabilities, and equity on the right-hand side. And equity is just the assets minus the liabilities. And so related to this, this sort of very simple partitioning of the balance sheet is this quantity that people refer to as leverage, which is a very important quantity in sort of thinking about the amount of risk in a system. And the leverage is just the assets divided by the equity. So the more equity you have, the lower your leverage is. And and another way to think of it is that it measures the extent to which your assets are financed by debt, money that you borrow. Okay, so why is it useful to think about balance sheets? Well, what happens to a balance sheet when the price changes? And so the first thing that happens, so imagine you're holding, let's just think about a single asset. The price of that asset goes up for some reason, and so now your assets are worth more. So the asset side of your balance sheet has increased. The liabilities haven't changed. You haven't borrowed any more money, and so your equity goes up as well. Now, proportionally, your equity has gone up by a higher fraction than your assets have. And so, if you're a homeowner, right? If this is your house that just went up in value, and that's the money that you borrowed for your mortgage, your leverage just went down. Okay, so this is sort of for households, when asset prices rise, leverage tends to go down. Okay, so that's what's called counter-cyclical leverage. Now, if you're a bank, it turns out that you think about this sort of rather differently. Up to this point, it's the same as household debt, but a bank has some risk management strategy, and it looks at this and says, oh, this is great. The probability that I'm going to become insolvent just went down. And now I have, I can go to my, my risk manager can say, oh, you know, the risk level of the bank the value at risk just decreased. We can now go and purchase more assets, and so the bank then borrows more money and buys new assets, and in doing that acquires more assets and also more debt. And in fact, if they do enough of this, they can make the leverage go up rather than down. And so this is what is called procyclical leverage. And this may seem like a funny thing to do, but there's some empirical evidence that this is actually what happens in the banking sector. That if you look at the correlation between asset growth and leverage growth, it's positive, right? So this plot here shows that that leverage is generally procyclical. So banks are these sort of particular and odd characters in the financial world that when that because of the way they manage risk and because they're aggressively pursuing profit through leverage, that rising asset prices lead to higher, not lower leverage in the banking system. And so just to recap that, you see a rise in asset prices, bank equity increases, so then they observe that their probability of insolvency decreases, they want to take more risk, they buy more assets, and of course they might also think, oh, these assets that are going up are going to continue to go up, so we want to get in now, and then leverage increases. And so aside from this notion of procyclical leverage, the other term that I want to emphasize here is what is called inside money. This is the money that banks just create out of thin air by adding liabilities, adding to the liability side of their assets. So this is something that banks almost uniquely get to do because outsiders treat deposits as a substitute for currency. Right? So you put money in a bank, you don't think that it's going to go away. Right? So you're treating a deposit as if it's hard cash, and so banks are able to, because other people have this faith in them, they can just create money out of thin air by just, you know, they give you a line, they just credit, they just can create a line of credit for you. Okay, so this is up till now not new. This is observations that other people have made about leverage in the banking sector. What we are going to add to it is to show that this notion of procyclical leverage that is driven by banks' ability to create inside money can also lead to banking crises. And so the way we're going to do this is in a very, very simple model where we just have two types of actors. We have banks and we have investors. We don't have any networks. We don't have any heterogeneity. There's just one big bank in the world and one big investor. And it's a very simple type of investor. It's just a real money investor, not a hedge fund. The investors are not leveraged. They're just like pension funds or mutual funds. And so they just buy and hold assets. And so the investors have some of their money that they hold as currency, and they have other money that they hold, that they deposit in the banks, and we just think of this as these can be money market funds, but we're just going to think of them as just ordinary deposits. And they can also hold these risky bonds. So we call these bonds, really think of them as sort of asset-backed securities. So there's some real estate or whatever in the real world that's ultimately backing these assets. And both the banks and the investors own some of these bonds, right? Own some of these assets. And so all that's going to happen in this model is that banks and investors are going to change their beliefs about the value of these bonds, and then they're going to, because they have, even though they actually hold the same beliefs, so these are common beliefs, because they have different utility functions, they have different ways of thinking about risk, they're going to, when the price changes, they're going to exchange these bonds backwards and forwards, and that's really all that's going to happen. So the banks are following this risk management strategy that is sort of, roughly speaking, a version of a value of risk strategy, where they're maximizing their equity subject to some insolvency constraint. If they don't want to go, they don't want to become insolvent. So they set some sort of threshold that says, let's say I want the probability of being insolvent to be less than 1%, and then subject to that, I'm going to leverage up as much as I can, right? And then the investors are risk averse and just have a sort of concave utility function, right? So they have somewhat different utility functions, and when the banks buy, when the price goes up, the banks want to buy bonds from the investors, and so they can just buy some amount. I'm actually skipping over a lot of the details here, but I can certainly share the paper with you if you're interested in it. I just want to give a sort of flavor of this model. So the banks acquire assets from the investors, and then they credit some fraction of that amount to the deposit. So there's some of it goes to the investors hold some of that as currency, and the rest of it they redeposit back in the banks as a deposit. Okay, so that's really all that's happening. In the background, they have some belief about the value of these asset-backed securities, so that we just normalize everything to the unit interval, and we assume that there's some sort of distribution of beliefs about the value of these bonds that will be realized at the end of time. And what can happen, or the only exogenous thing that happens in this model, is that over time new information arrives, right? So suddenly we get some news about trouble in the subprime mortgage market, that housing prices are going down for the first time in many years, and so now we have our belief about the value of these assets shifts downwards, and so this is what we refer to as a negative shock, and likewise we can see a positive shock, that things can get better, right? So in the lead up to the financial crisis, real estate values were going up, everybody was becoming increasingly confident in the value of real estate-backed assets, and so we can see both positive and negative shocks happening in this model. Okay, so when one of these shocks happen, the banks and investors sort of modify their demand. They can have either positive or negative demand at different prices. Right? So depending on what the price of the bond is, both the banks and investors will have some demand, and then as a result of that, there'll be some trade, and then everything will re-equilibrate. So we go through a series of stages where you have some consistent set of balance sheets, and then new information arrives. Now the balance sheets are no longer consistent, and then some trade happens, the price changes, and everything goes back to being consistent again. And so this is all that happens in the model. So just to recap, we start with a consistent set of balance sheets where nobody wants to do anything. A belief shock comes along that makes the balance sheets now inconsistent. Some trade happens, we go back to consistency, and then we just repeat this until we run out of time. So again, avoiding all the details, we make some specific assumptions about the shape of these functions, I don't think any of our results depends too much on the particulars, but I just want to point out that, so this on the left-hand side are the demand functions for the banks. On the right-hand side, in the middle rather, we have the demand functions for the investors. And on the far right, the sum of these two is the aggregate demand function. And where the aggregate demand function crosses 0, the roots of that function are the equilibria for the price. Okay, so this is how we determine how prices change, is that we just sum up the demand functions after a belief shock happens, and then we can just solve numerically for the new equilibrium price. And the important thing to notice is that in a positive shock, so this is where good news arrives, the demand functions are all downward sloping. They have these weird kinks in them and everything, but don't worry too much about that. The point is that they're downward sloping, and so there's always a unique price at which the demand function crosses the origin. But when there's a negative shock, we see something different. The investors still have negative downward sloping demand. So the higher the price is, the less of the asset they want. But the banks are in this somewhat different position where they actually want to offload more of the asset the lower the price is. Okay, so this is the pro-cyclical thing coming in. Right? The banks are different from investors in this very in this one particular way, which is that they want to sell, but they want to sell more the lower the price is. Okay, and this turns out to be the really critical thing that drives all the rest of the data, right? Because now you see there's potential here for multiple equilibria, right? So to see that, if we think about a negative shock, a mild shock just moves the price down a little bit, and you have a single unique equilibria. But if this shock is bigger, the bank's demand function goes down, becomes more negative, and so the aggregate demand function now crosses the the appearance of a saddle node bifurcation, and so now we have 3 equilibria, one unstable one in the middle and 2 stable ones. And what's interesting about these 2 stable equilibria is the blue one is one where the world is in a good place, the banks are solvent, but in the red case, the banks are actually insolvent. So this is where we see a banking failure, and it's sort of indeterminate which of these equilibria will end up in. And then finally, if things get worse, we are left once again with a single equilibria, which is now a bad equilibrium. And so we can sort of summarize that picture in a 2-dimensional phase diagram here down on the bottom right. So these are the 2 parameters of, it's a beta function is the distribution of beliefs. We could have picked some other distribution. It has 2 parameters associated with it, which roughly determine its mean and its width. And you can see that, that we start off in a particular part of this space. This is the alpha 0, beta 0. And then depending on depending on what sort of shock we receive, this equilibrium will move to a different part of the space, right? Sorry, the point will move to a different part of the space. Currently, so we imagine that we start off in a solvent world, right? We assume that the world starts off in a good place. And then you can see that in this phase diagram, there's 3 separate regions. One is where we have these 3 equilibria, and then over on the left, we have a world in which there's a single insolvent equilibrium. And so now we just want to understand, you know, how do we sort of, what is the sort of sequence of shocks that can lead us into this insolvent equilibrium. And the thing that the main result that's a little bit, well, I mean, if you're familiar with nonlinear systems, it's probably not that intuitive, counterintuitive, but it's a little bit counterintuitive, is that there's some very strong path dependencies in this model. So it's clear, going back to that previous figure, that if you have a sufficiently big negative shock, you go from a good world to a bad world where there's insolvency. So that seems pretty straightforward. Slightly less obvious is that if you first receive a positive shock, right? So first you get good news, right? And then you receive a negative shock of the same magnitude, right? You, in some sense, just go back to believing what you believed in the past. Intuitively, you might think you should just go back to the same state that you were in before. But of course, what we find is that these two shocks don't cancel out. That in fact, you can get a bankruptcy crisis or a catastrophe, because it's a mathematical catastrophe, when you simply reverse an earlier positive shock. And so the way you can see that is through this phase diagram again. So this is a little bit of a complicated figure, but the gray region on the left-hand side and the black dot are exactly the figure that I just showed you in the previous slide. And what happens now is that we first give the system a positive shock. And because when the banks receive positive information, they increase their ownership of the bonds, and they also increase their leverage, the location of that three equilibria region shifts over to the right. And so in the green case, the case of the green arrow, you get a small positive shock, and the green the position of the boundary shifts a little bit to the right, so you get this green shaded region. And qualitatively, nothing has really changed, because if you go back to your original state, you're still on the right-hand side of the green region. But if you get a big shock corresponding to the red arrow, the intermediate, the boundary shifts far enough over to the right that your original position is now on the left-hand side of that window. And so if you reverse the shock, you're now in an insolvent state. So that's sort of the intuition for how you can get insolvency out of a positive followed by a negative shock. And I just want to give some very pseudo-empirical evidence that this is not entirely unreasonable. If you look at US housing prices measured by the Case-Shiller index, this big peak in the middle occurs between January in roughly the year 2000 and 2008. So over the sort of the interval between the end of the dot-com bubble bursting and the beginning of the financial crisis, roughly speaking, we saw housing prices go up and then come back down to where they were. And so in some sense, in 2009, we were really at the same point that we were at in 2001 when there wasn't a financial crisis. And yet, we didn't just go back to that state of the world. We had there was a state of potential insolvency. So that's sort of the argument that this model is not entirely, it's capturing something reasonable about the world. And then just to sort of ask the question, is there any leverage that we can get out of a model of this type that might inform policy? We can very easily add in an additional constraint into these demand functions that correspond to capital requirements. So now you can just add a rule that says, in addition to maximizing your expected equity, banks also have to make sure that they don't exceed a particular leverage, which is specified by some regulator. And this turns out to have two effects, one of them good, one of them bad. The good news is that when we impose a sufficiently stringent capital requirement, it mitigates this effect that I just went through of the windows shifting under the positive shock, and we can manage to keep all of them to the left of the original equilibrium. So now we've eliminated this possibility of positive shock followed by a negative shock generating a crisis that doesn't have to happen. So by sort of limiting banks' ability to get excited and leverage, increase their leverage in the face of good news, sort of the sort of taking the punch bowl away idea, it can indeed add stability to the system. But, and certainly people have warned about the other problem, which is that if you don't relax capital requirements in the face of negative shocks, it can actually make things worse, right? That if banks are not only inclined to sell their assets or offload their assets when negative information arrives, but in addition to that, they're also being forced to do that by some capital requirements which have been imposed on them, then in fact you can erode, what we show here is you can erode this buffer zone, and instead of getting into a sort of semi-bad situation where you have a stable, where you have a good and a bad equilibrium, you only have the bad equilibrium. So capital requirements can be good and they can be bad, and I think it sort of is consistent with the advice that people like Marty and Helwig have given, which is that capital requirements are generally a good thing and you should insist on them, but that they should be dynamic in the sense, or countercyclical in the sense that they be increased in the good times and then relaxed in the bad times. And we're finding something that's very consistent with that. So what have we learned from this very, very trivial model? Just that we can, in a relatively straightforward way, link beliefs to trade between banks and investors, that we can then derive corresponding changes in the prices and balance sheets, and we can find interesting conditions under which insolvency can arise. So it's a very simple model, and there's sort of all sorts of ways in which it is unrealistic and therefore sort of not difficult to apply to the real world. We don't have heterogeneous actors. We don't, with different sorts of beliefs. We don't have networks of interactions. We don't have multiple assets. We don't have a lot of the things that I talked about at the beginning that make that would make the model realistic. But it does, in its extreme simplicity, demonstrate something that's a little unsettling, which is that you really need very little to get this kind of catastrophic failure. Right? That you can get it from just a very sort of simple behavior that is seems entirely justified within the framework of a value at risk risk management practice. That all you need is the ability of banks to create inside money and their inclination to increase their leverage in the good times and decrease it in the bad times, and that's all you need, and you can still get catastrophic failures. And so I think it's and from that you can already, even in its simplicity, generate policy actions that that have been sort of suggested by other people for other reasons. Okay. So right, so there's a lot of things that are missing. We assume that these beliefs just kind of arrive out of the sky exogenously. In fact, all the stuff about information contagion suggests that people are updating their beliefs as a function of what other people are doing inside the system. That seems to be important. We also assume that everybody's homogeneous, so there's no disagreement about what things are worth. That's probably important. By modeling things at the sector level, we keep things simple, but we also omit all the interesting internal dynamics. We don't allow investors to have any leverage, so that seems important as well. We don't allow banks to create new assets. right? So there's no origination properties. That's another important thing that banks do, is they go out and they actually increase the supply of assets by issuing new mortgages, for example. And we don't allow that. And of course, we also assume that the money that banks create is like really kind of insured, like a FDIC insured deposits. And so the future work is then to, of course, relax all of these constraints. And you know, you can just imagine layering like the rings of an onion, more and more complexity on top of this very core basic model. And that, to go back to my sort of opening statement, was what we were intending to do. That we started off with the very simplest, most stripped down thing that we could possibly imagine that would have any kind of dynamics at all. And then we thought, okay, we'll then go to have, you know, multiple banks, multiple assets. We'd like to you know, include things like sale and repurchase agreements with repos. So now we can have you know, beliefs entering through haircuts. We want banks to originate assets. We want the Fed to be involved. You know, we want all of this realism to be added. But given the difficulty of analyzing even this like ridiculously simple model, we you know, I almost threw up our hands at the prospect of making it even more complicated. That it's sort of quickly becoming intractable while still being so simple that you can't really believe it. And so this is, again, sort of a bad place to be as a modeler, where you would like to have it the other way around, where you're still able to handle the complexity and you're increasingly confident that your model resembles something in the real world. So with that sort of dismal conclusion, thanks, and happy to discuss this work or some you know, other thoughts for future work.
Thanks, Duncan. That was a lot of fun. Depressing, of course. Another thing that seems to me is not in the model, and one is things that are exogenous to the system, like the labor market, that might be affected by this system and then feedback to it.
Right. Yeah. So there's no economy here. Like, right. So you know, I gave this talk at a Bank of England conference last year, and I thought I had given this sort of exhaustive list of all the things that, you know, could drive you know, systemic risk in financial systems. And then Franklin Allen got up after me and said, you know, Duncan Watts has this very narrow conception of systemic risk in financial systems. And I thought, oh dear, like, and so he was adding all this other stuff, like, you know, like political instability and you know, and labor markets and exchange rates. And so, yes, if you sort of broaden your horizon outside of you know, the financial system, you know, really you're talking about the entire global economy at some level. At that point, nothing is exogenous. Everything is now endogenous. Everything is systemic. But so I don't know how to think about that, like this sort of what do we call it in sociology, Matt? The boundary problem?
Scope condition, or where the edge is.
Where you put the edge,
yeah.
You know, and so we've made a very specific choice of that.
Do you think that some of the problems in 2008 were because people who were making the decisions were trying to view the system as a closed system and ignoring these knock-on effects?
Yeah. Well, I think that, I mean, so actually, so the other boundary is time, right? And I think that a sort of tectonic driving force behind all of this is, you know, basically global inequality increasing, meaning that there's a sort of a bunch of very wealthy people who have enormous assets and want to invest them in some, you know, and want to generate a return. And so a lot of the innovation that happened in the financial industry was in response to a demand for AAA rated low risk assets that generated a yield that was higher than government bonds, right? And so so you could argue that in order to understand systemic risk, you have to really sort of think about the distribution of wealth and the pressure that builds up when you have too much money chasing too few real economic investments. And so financial engineering comes to the rescue, and there are obviously a lot of people in the financial industry who are highly motivated to produce these instruments because it benefits them. There are customers who are really eager to invest in them because it benefits them in the short run. And so, you could model that process. And in fact, I think there are models of that process. But then that's somewhat separate for that sort of how does the stuff build up in the background, and then there's the sort of how does it sort of manifest itself when the chickens come home to roost.
Yeah.
So yes, we're definitely splitting off banks and investors from the rest of the economy, and we're only thinking about the sort of dynamics of a crisis in the very sort of limited time scale of all this stuff has kind of happened, and now, how do we understand the world? So yes, I think that, really, the problem is that once you relax all those boundaries, you're sort of trying to understand the whole world. It's like, what isn't in this picture now? Climate change. I think Franklin Allen even included climate change in his it's sort of like, well, now you have to really need a model. You need the Club of Rome. You need the sort of the model of the entire world.
And you started out talking about exogenous shocks, but a lot of these are probably slow variables that are really part of the system.
Yeah. So yes, so at some level, nothing is exogenous anymore, except maybe sunspots, right? But now we have this system that, it's like even worse than, it was already bad enough when I was, describing that list of mechanisms, but then it gets really ugly. So there's this trade-off, right? That you want to kind of keep pushing the boundaries back, but you also want to keep a handle on the thing that you're trying to understand. And it's not clear to me that there's a good trade-off there, right? And that's what's worrying, is that you sort of get to a level of complexity that is unacceptable before you get to a level of realism that is persuasive. Yes?
So I thought this was very nice to basically the model to show how simple it is, how easy it is to get these catastrophic events. I was wondering, of the limitations that you're not including, if you were to layer them on, which ones would increase robustness of the system rather than make it, I mean, is there some sense, some intuition?
Well, the Fed.
Yeah.
You hope,
but in
right?
terms of heterogeneity and some other kind of...
Well, the Fed was something that we wanted to include, so we don't have the Fed in the model, right? Like we sort of have a hand-wavy version of the Fed where we coordinate beliefs on positive equilibria, right? But the Fed, of course, actually does real things to try to coordinate beliefs on the positive equilibria. So a lot of the facilities that the Fed set up during the crisis, where they were sort of exchanging questionable collateral for treasuries, was really just trying to bolster everyone's beliefs in the value, the underlying value, the fundamental value of the assets, right? And so there was you could sort of think of that as a massive belief coordination exercise. The problem is that we don't have a model that tells you how much, like this particular, they have a bunch of these facilities with different four-letter, TFLs, Fs or something, TSLFs, term short line facility. So there's a bunch of these things with funny acronyms that they created over the course of about a year or so. They're just, they're just trying stuff, right? And it's very hard, you would like to, as a policymaker, you would like to have you'd like to be able to sort of say, well, I've got this model where I have the levers in the model, and I want to pull this lever, and this lever has more of an effect than this lever, so I want to pull this one. So that I would like to see in there. But then, in terms of adding extra, multiple assets, multiple banks, so I don't know that any of them intrinsically increase or decrease stability. I mean, this is sort of one of the, heterogeneity could enhance stability, but it could also reduce stability.
What would you expect heterogeneity in risk tolerance of investors?
Well, right. So that's supposed to be a good thing, right? You sort of want that in the world, but that you want to have some investors who have the ability to absorb highly risky assets, and one argument about what went wrong is that there were highly risky assets that were being packaged and sold as not risky assets, and so the investors who were buying them and the banks themselves were not equipped to be handling highly risky assets. So, I mean, in general, heterogeneity seems to be a good thing, but it's tricky because even a lot of one of the arguments about collateralized debt obligations was that they were diversifying their risk by spreading it across different types of real assets. But different banks were diversifying in the same way. And so everybody individually thought they were diversified, but everyone was the same. And so they were all vulnerable in the same way. So it's not, even just sort of simple things like quantifying diversity become complicated when you have sort of things happening at multiple scales. But that would be a nice thing to be able to do, is say, like, add these things in, are things getting more or less systemically risky? And I think going back to my first slide, that's a property that you would like to have. Yeah, I don't know if we have that. Yes.
Thanks for the talk. I'm actually not an economist. I just saw the poster and it sounds interesting. I'm a software engineer. And you made it so easy to understand, so it was really nice to understand the problem. What I'm worried, and you mentioned it a few times, and I think that's a follow-up to what was discussed, is that you presented that simple model and understood the problem, and then in your conclusion slide, you actually gave some suggestion, recommendation how to solve that problem. And you also said, well, this is actually great because some other guys already suggested similar, so that corresponds. And I'm worried that the complexity of the system that you yourself saying it's so complex, we don't actually understand that. So even though those measures make sense to us, make sense to me, they can actually have some kind of negative impact.
Like capital requirements?
Yeah, that was
well, capital requirements do have a negative impact. Yeah. They reduce the profitability of banks.
Yeah, but I'm just, what my point here is that you're saying, well, our problem is we don't have a model. I'm saying maybe our problem is we do have a model, right? So a lot of them have a model and just stick to it. And you're saying all those disclaimers saying, well, this is not a perfect model, but a lot of them don't actually listen to that. They just say, we have a model, this is our risk, and that's how we're going to do. And in the end, they're going to be... Yeah.
So this is a very sort of Nassim Taleb critique, right?
I guess,
that models were the problem. And I have some sympathy for that argument that that the problem to the extent that if you have a model, you can become more confident in your beliefs than you should be, right? And this can certainly be true. And value at risk is a great example of that. It's a model of risk management that a lot of people have adopted, and you can sort of say very confidently, our probability of insolvency is less than 1%, and because we have this model that says that, and so now I can sort of possibly use that to increase my leverage. Whereas if I didn't have the model, maybe I would just think, oh, I don't know, it seems like a bad idea, maybe we shouldn't, and maybe the world would be better if nobody had these models and they just had to rely on their intuition. And possibly something similar could be true if regulators had models and they said, oh, our model tells us that the ideal capital requirement is like 30%. And so now we're going to change the regulation so that all banks have to have 30% of their assets as equity. And maybe that's going to have some other unforeseen consequence down the road. That could all be true. It's the converse that I don't buy, which is that we're sort of better off if we don't know anything, right? Like if we don't have models, that people suddenly become cautious, right? I think we have lots of examples in the world where people did really stupid things just based on their intuition, right? And policymakers and financiers, and so I'm not sure that intuition and common sense are lead to less risk-taking behavior than sort of financial engineering. But I think it's a reasonable thing to argue about. And I think that when I say it'd be good for regulators to have a model, I guess what I really mean is that, capital requirements is like the perfect example, because, you have, why should it be 100%? Why should banks be able to buy assets with debt at all, right? Maybe they should just always go out and raise money from investors, and then they use that money to buy and hold assets, and, that's what mutual funds do, right? Why shouldn't banks do the same thing? Well, that would make banking very unprofitable, right? Because they couldn't, lend out money long-term and borrow short-term, right? So the banks certainly wouldn't like that. And so if you look at, capital ratios over the last sort of century, they've been going down and down and down and down to, sort of single-digit percentages. And, the banks have a story about why that's true, which is like we've got better risk management practices, and so there's no inherent reason why this capital requirement should be any particular value, so we'll just keep pushing it down. And then you have people like Ed Marty and Hellwig come along and say, no, that's really bad, it should be 30%. And the banks say, why 30%? Like, you just made that number up. And so I guess what I would like is there to be a more principled way to arrive at that number, and to say, yes, you're decreasing the profitability of banks. You're possibly not loaning out as much money. Maybe it's slowing economic growth. But the plus side is that you're reducing systemic risk, and so I can sort of, now we have these things that we can trade off against each other. We can say, here's the balance that we're going to strike. And currently, I think it's a rhetorical argument. There's not really a sort of principled way of deciding what that number should be, and that's what I mean by a model, right? But if the model's wrong, then you get the wrong answer. So I don't know how to solve that problem. Yes, Matt?
About the sort of multiple mechanisms and the interaction between them, and then the model getting more and more complicated, I'm wondering to what extent you think data or empirical observation can help you rule out certain mechanisms, or decide that they're actually really strong or weak in certain situations, so simplifying through data.
Well, I certainly think it would be great to have better data. I think that that we do these modeling exercises in large part because we don't have access to the data. I'm not sure that would make it simpler, right? I mean, think about just sort of, banks have to publish their balance sheets. There's a lot of information that is not ever made public. The Fed has access to some of it, but they don't have a complete picture. So nobody really has a sort of complete picture of the financial system. And I don't know if there's any sort of legislation in the works that maybe somebody here knows if if that's going to change at any point in the future. It seems pretty, that seems pretty grim to me. Yeah, I don't know if, and you know, you still really can't conduct thought experiments with data, right? Like you can't, you know, so some of these sort of properties that I was saying we would like to have about like sort of what if scenarios, right? Like the data can give you a picture of the state of the world, and you know, it can sort of give you some trajectory of previous states of the world, but it can't really tell you, you know, that things are going to explode if you know, a particular event happens. So I don't think that that we sort of get out of the woods, the modeling woods, just by having data. But it would certainly be nice to be able to calibrate some of these parameters, and maybe yeah, I don't know. So maybe what you're saying is like you might find that some of these mechanisms aren't so important. Yeah, I mean, maybe we would find that. I'm not sure. Yeah.
Since you're someone with a physics background, I'm curious of your point of view on one thing, which is that even though you have all these diverse mechanisms that can intervene in chemistry or physics or mechanics, the direction we would have to something like this is maybe for all those mechanisms there are some underlying conservation principles or symmetries or properties that constrain how they can apply. Even though they are very different, there will be always things that constrain the range of what they can do on the system actually. And do you think this approach is actually completely impossible here? Or has it been attempted at all? Or,
well, the system's certainly not conservative, right? And that you can like, you know, create money out of thin air, right? The reason why I sort of described these mechanisms as being in 4 different classes is I really think they're really different. They're fundamentally different principles at work here, and that you could clearly have one of them operating and not any of the others, right? And so in that sense, they're independent, right? I mean, they're not actually independent in real life, but they could be, right? You could have knock-on contagion without information contagion, right?
yeah, but
You could have information contagion without knock-on contagion, right? So it's possible to write down a model, and people have written down models that have one of those things and not the others, and you can get something that looks like systemic risk out of those models, right? But if you then sort of concluded and said, okay, we've now understood systemic risk, you'd be wrong, because you know some entirely other thing than what you had in your model could generate a crisis, and your model would have no ability to account for that, right? So that's a problem, right? Now, are there sort of meta principles that somehow subsume all of these things under the same umbrella? I'm not saying it's impossible. I certainly have not been able to see how that would be the case. Yeah, but you know, it'd be great if somebody were able to figure that out. It does seem like these things really are different, though. Yeah. Yes.
Duncan, can you, if you don't mind, can you go back to the slide where you show the utility curves of the banks plus the investors, and then you show the combined curve of the two?
This one?
That one right there.
Yeah.
So first of all, I want to thank you for an excellent talk, but I should probably chastise you for actually giving a talk on finance that's comprehensible, because I think that's against the rules, and that's one of the reasons we have these huge financial crises, is because nobody really like you said, nobody really understands the system or what's going on, especially the policymakers. So I'm looking at this, and am I to interpret that there's different types of risk aversion from the banks and the investors? And that's what we're seeing here with the shapes.
Banks are risk neutral.
Okay.
And investors are risk averse.
Exactly. Okay. So is that because of the principal agent problem inside the banks, that they are more agents than principals, and therefore they have asymmetric payoffs, whereas the investors have more, the investors, in other words, have more skin in the game. They don't get paid on bonuses. They actually lose their shirt when things go badly, whereas the the agents in these banks are paid bonuses, but they don't have to give back their bonuses.
Yeah, it could be. I mean, we don't really deal with that.
Okay.
We just sort of, take it as given that banks have a certain type of risk management practices, and there's, evidence that they do.
Okay.
And then we just assume that that's how they behave. Right?
So
this just follows from the assumption that they they're maximizing their expected equity subject to an insolvency constraint.
okay, so if you're combining these things using some sort of weighted average to get to the two, another implication is that the repeal of Glass-Steagall, all of a sudden, the banks became investors. And in doing so, you have people who are less risk averse who are now climbing into the market. And that's kind of the effects that we're seeing here. The more power the banks have, and then you had another slide where you show the roots as the combined curve crosses the x-axis in multiple situations, and the more power the banks have, the lower these equilibria are. In other words, the worse the crash. Is that one?
The Glass-Steagall thing is a little murky because it certainly was, part of a general trend towards, banks getting involved in businesses that were not traditional banking. But people have certainly argued that the real effect was the shadow banking, was the growth of the shadow banking industry, which was not regulated by Glass-Steagall, and so they, more or less could have happened anyway.
And are we
don't have any of that in this model, right? Like we don't have, so one thing that we would like to add is the equivalent of repos, right? The sort of overnight loan. So what we do have is effectively just deposits, but a lot of what happened in the crisis was investors wanting, so if you're Microsoft, you have like $80 billion in cash, you can't put that in the bank, right? And so, in a sort of FDIC insured account. And so what they do is they enter into these contracts that are called sale and repurchase agreements, where they're effectively depositing the money in the bank, and the bank is giving them collateral, which is all this stuff, right? And every day the contract gets renewed, but so the banks are then taking this money and they're going off and investing it in some long-term. They're lending it out long-term, so they're paying interest on short-term, and they're getting interest on long-term, which is so they're playing this yield curve. And then the fragility is that if the investor gets nervous, they can just ask for their money back. And if the bank doesn't have the money, then they have to, they start getting margin calls, and then they have to sort of sell off their assets. And so that is a whole other source of risk that we don't even have in here. So I'm actually not sure that Glass-Steagall would make any difference to this picture. Yes?
So did you find it, is there something wrong with Diamond Dybvig or any of the kind of workhorse models?
Well, that's really a model of bank runs, right?
Sure, but it's exactly what you just described with repos.
Yeah.
If they get nervous, they pull out. Very similar.
Yeah, so I think, so if we don't have a bank run, there's no bank runs in here, right? So I think Gary Gordon has said that, that the financial crisis was basically a run on the shadow banking. That the bank was we got rid of bank runs by, with federal deposit insurance, but but there's no equivalent of federal deposit insurance for, you know, money market funds and repos and this sort of the whole shadow banking industry. If you think of that as a bank, what happened is kind of like a bank run on that. And maybe Diamond and Didwig, you know, captures the flavor of that, but you know, it's not clear how you go from that model to sort of knowing what to prohibit. So this is what going back to my first slide. You know, if you have too general of a model, right, you can say, oh, everything's a bank run, right? That doesn't actually help you say, oh, we shouldn't let people use repos, right? We should regulate repos because, like, that doesn't look like a bank. It looks like a, you know, a particular type of, you know, exchange between investors and banks, right? So I think this is the challenge, or one of the challenges, is to sort of to you know, use these models to generate intuition, but it has to be specific enough to say this practice is generating X amount of risk, and you know, nobody in the Fed was paying attention to repos before. There were like no academic articles that mentioned repos before like 2009, right? Like just no one is a $10 trillion, you know, market, and like lots of people in the banking industry must have known about it because they were doing it. But no one in academia and no one in government had any idea that this thing was as big as it was. So, like, sort of, that sort of is, you know, that's really you know, the problem in terms of, like, you know, Diamond and Didwig didn't help us understand that repos were a problem.
Well, if there are no more questions, we just thank our speaker, and Duncan, appreciate you coming all the way down from New York.